Yes, Sahil, you can start.
Thank you, sir. Good morning to one and all present here. Hi, I am Sahil Bhutani from Amity Innovation Incubator and your host for the day. Thank you all for joining us today for our final session on term sheet for early stage startups from the ongoing series A to Z of startup investment. Before my colleague Mr. Vijayveer Singh introduce you to the speaker for the day, let me give you a very brief introduction about Amity Innovation Incubator. We take pride in introducing Amity Innovation Incubator as a very comprehensive startup ecosystem that exists in India, and it has been one of the first incubators in India. We started our operations in the year 2008 under the aegis of our honorable President, Dr. Asim Chauhan, sir, with a vision to ensure that a comprehensive ecosystem is in place to nurture entrepreneurs and strengthen the innovation culture at grassroots level. We have been supported by DST, Niti Aayog, Atal Innovation Mission, MIghty, and MSME. Till date, we have supported around 500 ventures, and we've invested in around 55 ventures through our investment vehicle Amity Capital Ventures. We started with a very reasonable amount of space with a 12,000 square feet of incubation space, which is now expanded to over 45,000 square feet at at the Amity University Noida campus, with a physical presence of across 7 states and 17 virtual locations in India and 7 locations abroad. We've been providing soft landing platforms for our incubated startups who are looking to scale up in the international markets. For more information on incubation and other kind of funding support, we'll be sharing the details in the chat. Uh, and now I would like to hand over the dais to Mr. Vijay Veer Singh. Over to you, Vijay, sir.
Thank you, Sahil. Thank you for introducing Amity Innovation Incubator. Good morning, everyone. Dear participant, thank you all for being a part of today's session. As you know, bringing in outside investor is an important step in the growth of most startups. Understanding the difference between kinds of investment can help startups successfully navigate the fundraising process. Most fundraising starts with a term sheet, and important deal terms are negotiated at this stage. By better understanding what term sheet should cover, startup can be better protected. Amity Innovation Incubator, as a part of its 3-session series on A to Z of startup investment, is organizing the final session today on term sheet for early stage startup. Let me now introduce you all to today's speaker. Mr. Jay Gandhi is a partner with Sardul Amarchand Mangaldas and Company based out of Mumbai office. Jay practice encompasses merger and acquisition, private equity, joint venture, and investment funds, and he has extensive experience across these areas, both on cross-border and domestic deals. For more than a decade and a half, Jay has been advising several large international and domestic private equity funds, banks and financial institutions, multinational corporations, and Indian business houses on various types of complex M&A deals, private equity and venture capital investments, and leverage buyouts. Jay is a qualified lawyer and a member of Bar Council of Maharashtra and Goa, and in addition is also a qualified chartered accountant. He has been involved in some of the largest foreign direct investment transactions that India has witnessed in the real estate, infrastructure, and media sector. Jay has been recognized as a notable practitioner by IFLR 1000 in 2019-21 in the investment funds, private equity, and M&A. On the behalf of Amity Innovation Incubator, I thank you, sir, for accepting our request for today's session on term sheet for early stage startup. Over to you, and looking forward for a very insightful session on term sheet. I'm hoping all the startups founders here can gain a lot of knowledge about term sheet and how while they are raising their first check can be very cautious on all the terms related to term sheet. Over to you, sir.
So, um, for those of you who are surprised at the actual look as opposed to the one that's on all of the flyers. I apologize for that. That's a combination of COVID and my daughter insisting that I need to have a beard. It's very good to speak to all of you this morning. Like Vijay said, I've been practicing for 17, 18 years. My practice areas are basically mergers and acquisitions, private equity, investments, and investment funds. And so over the years, I have had the chance to work with different investors who are looking to invest in startups, and have had the ability over time to look at the same issue that comes up in transactions from the perspective of the investor, as well as the perspective of the startup and the founders, and some of the peculiar problems that we tend to see in such transactions. The intention today is to make this a completely interactive session. So I'm very happy to take questions live as we go along. What I thought we could do is my colleague Joanna is here with me, and between the two of us, we have prepared a short presentation on the aspects that we believe would be relevant when any of you are negotiating a term sheet. And I do appreciate that all of you may not necessarily be at the same point of time in your fundraising process. There may be some here who are looking to raise their first check. There may be some here who may be looking to do a follow-on round or a Series A or a Series B. There may be some here who are advisors like Joanna and I are. And sort of just want to hear from others what their experiences have been. So the presentation that we put together is not very detailed intentionally. It is just talking points on particular topics. And so what I would like to do is I would like to dedicate about an hour to the conversation. Vijay, that's okay, right? About an hour for the conversation, and then some time especially for Q&A.
Yes, sir, we can do that, sir.
Yeah, and at any point in time, even during the aspect that is being discussed, if you have any questions, please don't hesitate. Feel free to ask your question. I think what you will need to do is you will need to use the raise hand function on the screen, and then Sahil will sort of will allow you access to be able to ask your questions. As much as possible, we would like you to ask the questions in a way that all the other attendees also know what is the question that is being asked. And I'll make all attempts to try and answer it then and there. Time may end up being a constraint. If that is the case, I'm happy to have a conversation after the session is over. You can reach out to me. We'll figure out a way for you all to reach out to us, and we can sort of continue to address questions that you may have. So with that, let me start. Joanna, do you mind putting up the... So like I said, the intention here is to only cover the key concepts that are of relevance in the term sheet. And rather than actually go into the language of what the term sheet should or should not say, we will just stick to the principles. Joanna, keep moving. So this is setting out what the stages of a transaction typically tend to be. And I know in the previous session, you had a speaker who spoke to you about how to pitch to investors and how to prepare the pitch deck. Just the way the life of the transaction typically goes. And again, depending on which stage you are at, this may not necessarily entirely apply to you. But broadly, the way this works is that once you prepared an info memo, you've circulated that to investors. If they demonstrate some interest and you want to take the conversation further, more often than not, it is advisable to sign an NDA or a confidentiality agreement. If the conversation does fructify into a meeting of minds, then you would sign a term sheet, and which is the focus of the conversation today. But just quickly covering off, once the term sheet is signed, you would typically do a diligence. Depending again on the stage that you are at, the diligence may or may not be a very extensive process. But post diligence, you would draft the necessary documents, a share purchase agreement, a share subscription agreement, a shareholders agreement, and you would sign those documents. There may be certain conditions precedent that would be required to be met. What are conditions precedent? These are things that the investor needs you to put in place before the investment can go forward. So for example, if you have a line from a bank and that requires a prior consent of the bank for you to be able to issue shares to a third party, then that becomes a condition precedent, right? And so there will be conditions precedent which will be factual to your company and your business. There is then the closing, in technical language, what we call the closing or the completion. What that means is the delivery versus payment. You issue the shares or transfer the shares to the investor, and in return, the consideration is paid to you or to the company, depending on whether it's a secondary or a primary transaction that you are undertaking. Depending on the investor, there may be some filings that are required. If it's a foreign investor, then the filings tend to be more, all of which are written technically in the documents as conditions subsequent. If they appoint a director, you will need to make a filing with the ROC, etc. So that's typically the life cycle of a particular investment, and broadly this remains the same. Irrespective of whether you're looking at a very early stage investment or a very late stage investment, even the buyout funds, for example, this broad construct would tend to remain the same. If nobody has any questions here, then I'll keep moving to the following slides. Joanna, will you move, please? So term sheets, right? What is a term sheet and why do we need a term sheet? And what should you keep in mind when you're signing a term sheet? Very broadly, a term sheet, more often than not, is not binding. It is non-binding in nature, except for certain identified clauses. What does it do? It basically puts down in writing the broad commercial understanding between the investor and you about the terms and conditions on which the investor will invest. And certain ancillary terms and conditions in relation to how the business will be managed, what are the kind of sort of covenants, etc., that you will need to agree to as a part of ongoing business and things like that, which we will cover in detail as we go along. There are certain aspects of a term sheet which are binding. The biggest and the sort of most crucial binding aspect of the term sheet is what is called the exclusivity clause, or in sort of layman terms called a no-shop clause. That's basically an obligation that needs to be undertaken by the promoter and the company, that once that term sheet is signed for a defined period of time, which is written in the term sheet itself, the promoter and the company will not speak to other investors for the same investment. Again, this is more typically in the later stage, Series A, Series B. But if you sign a term sheet, you will more often than not find that there will be an exclusivity clause written in the document, and that exclusivity clause will be binding on the parties. What that means is that in the event you sign up with that investor and you've agreed to a 30-day exclusivity window, for example, or a 60-day exclusivity window, then for that period of time, you should not ideally be speaking with any other potential investors. There are ways in which the exclusivity obligation is written. For example, there is a version of the exclusivity where if others reach out to you for having a conversation around the same investment, then you would be obliged to provide that information to the investor. There are some other exclusivity obligations written in a way that all you're supposed to do is, if somebody reaches out, just say that you're not interested in that conversation, but sort of nothing further. So it depends on the exact language of what is written in the exclusivity clause. But more often than not, in a very high proportion of the cases, if there is an exclusivity clause in the term sheet, it would be binding. A couple of other clauses that tend to be binding in the term sheet is the confidentiality clause, where you agree to keep confidential the terms of the term sheet, and the investor agrees to keep confidential the information that you provide to the investor as a part of the process of getting to the term sheet. If there is a separate NDA already in place or a confidentiality agreement, then this clause may not necessarily be required in the term sheet to be a binding clause. So it depends on, again, the fact pattern. And typically, because you have one binding obligation or two binding obligations in the term sheet, you will always have a clause which will set out that in the event there is a disagreement between the parties on how that obligation has been performed, or if one claims that there has been a breach of that obligation, then how will it be redressed, right? What will be the forum? What will be the law that binds the term sheet? So you will always have a governing law and a dispute resolution.
So we have somebody raising hands, Uday Reddy.
Yeah.
Uday, you may be, you may ask your question, please.
It's a quick question here. So when you say binding clause, what exactly does a non-binding clause mean, and what's an example of that?
Yeah. So what's a binding versus a non-binding? A binding clause is where both the parties or all of the parties who signed the particular document intend for it to be valid and binding between them. And in the event that one of the parties does not meet those terms and conditions, then it is possible for the other party to take them to court to seek enforcement of that obligation. If it's a non-binding, then there is no ability to seek enforcement. It is a reflection of the commercial understanding and a moral position that you are taking, but a non-binding clause of a term sheet can be changed. So for example, if you agree to a certain valuation in the term sheet, and in the diligence there are certain findings, then to accommodate the findings of the diligence, you may change the valuation. And so if the valuation is a non-binding valuation in the term sheet, then in the final documents, the share purchase agreement, the share subscription agreement, that is where the binding obligation will be captured. But because the term sheet is to give exclusivity for a limited period of time to that one particular investor who you have selected, the obligation of exclusivity is binding in the term sheet, which means that if the promoters or the company are in breach of that, if they speak to somebody else, if they solicit some other investments, then you could potentially be taken to court for a breach of that obligation. Is that clear?
Yeah, thank you very much, Jay.
Sure. There are some questions that have come in the chat as well, but I don't think that I am the right person for that. So what I'll do is I'll keep looking at the chat, and if there is a question that I think I can address right now, I will do that. Otherwise, we could have a offline conversation around some of them. Whenever there is a binding clause in the term sheet, there will always be a governing law, because, for example, if your investor is a non-resident investor, you don't want necessarily to agree that the laws of the country that he's in would apply to you. If the investment is happening in an Indian company, you would like that the Indian law should be the governing law. And so it is highly recommended that your term sheet specify the governing law, and specify that the governing law choice between the parties is also a binding clause of the term sheet, right? So that it goes hand in hand with the other binding obligations. Very, very strong recommendation in this day and age. Please do not agree to term sheets which do not have arbitration mechanism for dispute resolution. One hopes when one signs agreements that you never have to go to dispute resolution, but the reason you are signing an agreement is to cover all eventualities, right? And so please do not get to a place where you only leave the courts of a particular city, particular state, as having jurisdiction, it is highly recommended that even for term sheets that you agree that if there is a disagreement between the two parties, that will not necessarily have to go to court, and it can be resolved through an arbitration mechanism. I don't want to necessarily go into details of why arbitration as opposed to a court, but just the quick summary there is that it is time efficient, it is cost efficient, and it is binding. And the sort of the ability of one party to just keep seeking delays and subvert the process is quite limited. So strong recommendation from our side, from my personal side, would be that if you sign any binding contract, doesn't matter what the nature of the contract is, if there's any binding obligation in there, just make sure that there is an arbitration clause also, and that any disputes are resolved through arbitration. The other thing is the duration of the term sheet. Given that most clauses of the term sheet would be non-binding other than exclusivity, typically the duration of the term sheet itself mirrors the duration of the exclusivity clause, right? As soon as the exclusivity clause comes to an end, you're no longer sort of bound by the other clauses of the term sheet anyway, so the term sheet also comes to an end. It is ideal to have a specific clause in the term sheet setting out the expiry and the duration of the term sheet, so that nothing is left to chance, and it is clear on the face of it what was the commercial intent between the parties. Now, as to what is the right amount of time for exclusivity, that is actually a conversation that you need to have with the investor concerned. Depending on your fact pattern, this should be enough time so that the investor gets the chance to look at your business model properly, to look at your diligence process has to be completed properly, and to sort of have detailed conversations with you around the business plan and all of that. And within that time frame, you need to agree on the definitive documents as well. So all things considered, we've seen exclusivity being as low as 2 weeks, as high as 3 months, and sort of most often than not, somewhere in the middle of that spectrum is where you would expect the exclusivity obligation expectation from the investor to be. If there are no other questions on this, then we could move to the next aspect that we want to touch upon.
I think there is a hand raised by Aditi Sachdev.
Yes, please go ahead, Aditi.
Aditi, you're allowed to.
Yeah.
Yes, please.
So I just wanted to clarify that in the exclusivity clause, we say that, you cannot go shopping around for more investors. And in the confidentiality, we say that you cannot disclose the terms of the term sheet. But you did mention that in the exclusivity clause, there is something along the lines that if somebody approaches you, you're just supposed to say no. So I just wanted to delve deeper into that language.
Yeah.
That if the
So let me respond briefly, and then if you need to have a longer conversation, we could have that offline just to save everybody else's time. But what I meant to say is that the obligation of the exclusivity is that you will not solicit other investors, which you can very well meet, but have a situation where investors keep walking up to you, right? You spoke to them earlier before you signed the term sheet, and they are following up. And so what happens in that situation? The plain vanilla exclusivity clause will simply say that you tell them that you're not available for that discussion anymore, and that you're sort of in a binding term sheet with somebody else. But the more complex ones, and the ones that you see up the value chain, right? The bigger transactions, the later stage transactions, you would have an additional obligation that the investors may want to impose on the promoter, that not only will you not speak to anybody else, if anybody else reaches out to you, you will tell me who that is, right? Because then they get a sense of who are the other competitors who are looking to invest in the same product. So that's what I meant, that different exclusivity clauses are structured differently, but more often than not, the additional obligation that I'm talking to you about happens at the far later stage, right? Like a lot towards the end, maybe a buyout fund or something like that.
Understood. Thank you.
Sure. Is there anything else, Sahil, or should I continue?
Yes, Karthik is there, who is raised.
Sure, go ahead, Karthik.
Karthik, you may ask your question now.
Karthik, you need to unmute yourself. Karthik Subramaniam.
Hello, can you hear me?
Yes. Yes.
Yeah, very good morning. I just wanted to ask one question regarding the same question that has been asked right now regarding the investors and the confidential agreement. Now, let's say that the A investor is talking to me and this agreement is signed up with them, but the B comes in and we are not discussing with the first investor who has already invested, but the valuation of the second investor is higher to the first one. Then obviously any founder would be actually going for the larger sum, right? Once the agreement has been made. So there might be some discussions at which we can actually close in the first investor and go for the second one. There are some clause that comes in, right? So is there any clause of such confidentiality agreement at which we can negotiate with the first and the second at the same time?
Yeah, so fair enough. There are, I think, 2 or 3 written questions also around the same theme. So let me try and address each one of them point by point. And if something is sort of not yet clear, feel free to ask a further question. There is a question from Neela around the longevity of the term sheet and the exclusivity obligation in the term sheet. So the way this works is that the exclusivity obligation on the term sheet falls away on the earlier of 2 dates, right? Earlier of you signing definitive documents. So for example, and like you rightly pointed out, if you sign a subscription agreement or a shareholders agreement, that will then take over and you don't need to then worry about the term sheet because there will be a clause in the share purchase agreement that all prior agreements come to an end. To some extent, I think that will also address the question that the other sort of gentleman who was speaking had, that if you do want to speak to another investor, it's not like you can never speak to the other investor, but the exclusivity obligation simply means that if within the finite period of time for which you have offered exclusivity and you have not yet signed the binding documents, you cannot speak to any other investor. There are 2 related questions here. One is that what if the second offer that comes through is better than the offer that the investor who had in the term sheet offered to you? The real life answer to that is that these are things that you have a conversation with your investor. Once you sign up to exclusivity, it is not correct is one aspect of it and not legally advisable for you to actually have another conversation with another investor. You could argue with your first investor that I will give you very little time in terms of exclusivity to make up your mind and sort of leave yourself open to discussions with others. But if the investor in question does not believe that that is enough time for them to make a meaningful assessment of your business, then it is the proverbial 1 in hand versus 2 in bush kind of a situation that you would find yourself in. But in any case, if within the duration of the exclusivity obligation, so let's say you said 6 weeks of exclusivity obligation, if within 6 weeks you've not been able to sign definitive documents, then by all means you are free to speak to other investors. Now I'm speaking from a purely legal perspective. There is also obviously a relationship management angle to this, because obviously you don't want to rub off any investor the wrong way if you can avoid it. And so that's maybe a conversation that you should have with the investor in question as the term sheet comes to an end of its life. But there is one more question on the same point, that how do you cancel exclusivity before the time? You cannot. You can agree to a lower exclusivity period, or for example, you can agree with the founders in question, with the investor in question, that you will not give exclusivity, right? You will not agree to that clause in the term sheet. You could negotiate that, but the real sort of consequence of that may be that the investor may decide to not invest with you, right? And so whether or not you want to take that hard position is a difficult choice that you will need to make upfront at the relevant point in time. The last question I just want to pick up here is a question by Ajit Jain, which is that what is the market practice? Are investors enforcing exclusivity in term sheets? The real answer is more often than not, investors do not want to, for two reasons. One is that if they believe that if at some level the promoter's made up his mind that he wants to go with some other investor, then it may not necessarily be sort of conducive for them to continue the conversation, right? Even if they enforce the exclusivity and prevent you speaking to somebody else, they can't possibly force you to accept their money. So they are practical people, they see that. But at the same time, I would want you to be very careful that there will also be a perception that gets created that if you cannot abide by the binding obligation in the term sheet itself, then will you necessarily abide by the binding obligations of the share purchase agreement and the shareholders agreement? Or are you the type of promoter who will try to keep renegotiating on agreed positions all the time? And so a perception does get created of sort of the way the promoter deals with different investors. So there is a legal risk, which is that you will be taken to court, to arbitration for breach of the arbitration, breach of the exclusivity. Even if that is not the case, there is also a practical real life situation that you need to keep in mind. Investors speak to each other all of the time. And if a negative perception is created, then you will also need to then take extra effort to deal with that. So some of this, what I'm telling you is my personal opinion, obviously not opinion of the firm, or no, not necessarily the opinion that everybody else will hold. But what I do want to do is not just give you a legally correct, technically correct perspective. You also need to sort of know how the real life works around all of these things. So I'm trying to cover all of that. If you don't mind, I think it may make sense for us to move ahead from the exclusivity aspect and cover something else. And there is a way in which you can get in touch with us if you would like to. I think Vijay and his team will be able to sort of help you do that. Okay, so the first question is vehicle, right? If you're setting up a new business, what vehicle do you use? The two options that are available to you are to set up a private limited company or to set up an LLP, a limited liability partnership, for a variety of reasons, including the fact that a limited liability partnership is a relatively new vehicle. There are some restrictions around under foreign direct investment rules. There are some restrictions around LLPs. So for a variety of reasons, strong preference of the investor community is to invest in a private limited company. And so our recommendation would be that you house your business in a private limited company as opposed to in a limited liability partnership. This entire presentation is working on the basis that it's a limited liability company, a private limited company that you've set up, and not a limited liability partnership. Some of these concepts don't apply to a limited liability partnership. When you set up a company, the investment that the investor makes could either be of equity investment or it could be debt investment, right? We're not dealing with debt investments. We're not dealing with that in this conversation. The focus here is on equity investments. Equity investments can be structured through different instruments, and so we will cover all of that. But at the end of the day, this is not a loan that you are taking. This is an investment that you are taking, and that's something that I just wanted to clarify. Typically, there are three types of instruments that are possible. There are equity shares, which is the shares that all of us know and are familiar with. Within equity shares, you have the ability to issue shares with differential rights. When I say differential rights, these are differential rights as to voting as well as to economic return. So for example, you could have a particular type of share where you don't get any dividend. Okay, or for example, where you don't get any voting rights. In fact, if I'm not mistaken, Tata Motors used to, or currently still does, have a listed share, which is a differential share. There tends to be a difference in the pricing of such instruments as well. For a variety of reasons, you would choose to have shares with no voting rights. So very recently, we were representing a company we were representing an investor which made a investment in a company by buying out the shares that were allocated to the ESOP pool. The employees in question wanted an exit, and so they sold those shares. And because these were shares that were given to the ESOP pool, they were structured as non-voting shares, right? And so for a variety of reasons, you may want to explore either vanilla equity shares or equity shares with differential voting rights. If you're not looking at equity shares, the other option available is a preference share. Preference share or a debenture is popularly also referred to as a convertible instrument, right? A convertible instrument, as opposed to an equity share, is an instrument where upfront you don't know the number of shares that you will hold, and you don't know the percentage stake that you will hold. And when I say you, I mean this is all from the perspective of the investor, right? So the investor does not know the proportion of the stake that he's going to hold. It is linked to certain future milestones on the basis of which conversion would take place. In the convertible instruments, you could either have an equity-like instrument or a debt instrument. A preference share is still a share under the Companies Act, and it has preference in receiving dividends and a preference in liquidation. And so it sits above the equity share in a waterfall of returns. And that is sometimes preferred by investors to come into the company as an investor. The conversion terms, there are some peculiarities. We will cover that in the next slide here. But you could have either compulsorily convertible preference shares, or you could have redeemable preference shares, or you could have non-convertible preference shares. And which is the right instrument for you? You should sort of decide that together with the investor. Just to give you a sense of what real life investment structures look like, we represented another client recently who invested in large unicorn. We were a late stage investor. We came in quite late into the company after it was already a unicorn. And the securities that were issued to us were preference shares. And just for your information, this was the Series J. Okay, so they had started with their investors, the earliest investors, with Series A. So Series A, B, C, D. Now they are currently at Series J. And I do know of other companies where it is far beyond J. So it depends on the number of rounds of investments that have happened in the particular company, but you could have several series, and the difference between the various series would be that there'll be some difference in the conversion terms or in the liquidation preference terms or something like that, which is why you would have different series of preference shares. Everything that I told you about the conversion of a convertible instrument when it is a preference share equally applies to a convertible debenture. The only difference, the key difference, is till a debenture converts into equity shares or preference shares, till that time it is technically a debt on the books of the company and not considered as a part of the capital for any regulatory purposes. So some investors will prefer coming in through debentures as opposed to preference shares. A lot of this determination is also determined by the tax treatment of the conversion of debentures versus conversion of preference shares. And so it is the investors managing to some extent their own taxation, which will also play a large role in the choice of the instrument. One benefit that a debenture has over a preference share is that preference share, the returns that you give to the investors are dividend under the Companies Act. So you need to meet the threshold, which is that you need to have accounting profits, and the taxation is different for dividend. However, if you have debentures issued to the investor and you're giving any returns, any coupons, that is interest payment. So at the company level, the company which is making the interest payment can seek a tax shield. They can seek a tax deduction for the amount of the interest paid, which is not the case if you pay dividend, because the dividend is a below the line item. Like I said, the final decision on whether a debenture makes more sense or a preference share makes more sense or equity makes more sense is taken together with the investor, keeping in mind the overall efficiencies that are brought into the structure. If there are particular questions, I'll pause here for a minute. Otherwise, I can move to the next.
We have Aditi Sajdev with a question.
Yes.
So Jay, I just wanted to understand that there are times when investors go for preference shares also, and maybe a handful of equity shares. So what is the reasoning like behind this sort of structure? Like, how does it help?
Yeah. So so clearly, Aditi, you had a few conversations with a few investors. There is a technical reason under the Companies Act. So there is a concept of minority protection under the Companies Act, where if the minority investor believes that the promoters or the majority shareholders are acting in a manner which is not in the benefit of the company, it's called oppression and mismanagement, then you can seek recourse to the National Company Law Tribunal. For that, you need to hold more than 10% of the equity shares, and so that's why. That's one of the reasons. The second reason is if you hold an equity share, then you are required to be invited to all shareholder meetings, the annual general meeting and the extraordinary general meeting. If you don't hold those shares, then you may not necessarily be required to be invited. So investor community has had experiences over the years where sort of some promoters may have tried to sort of play a fast one. And so these are all protection mechanisms that have come over time to make sure that that the investor interests are also protected. Does that answer the question, Aditi?
Yeah, I got it broadly. Thanks.
Sure. So there is a question from Param on the chat. Param, why do some investors use iSafe Notes? I think it's a iSafe Notes, from what I understand, is a sort of step in between. This is to avoid having to negotiate a full-blown shareholders agreement. So iSafe Note, the note actually is a preference share, at least to the best of my knowledge. And I was just speaking to the 100x folks yesterday evening. So iSafe Note itself is a form of a preference share. So it's the second column on the slide. But what it does is the terms and conditions are built into that document so that you don't have to negotiate a full-blown shareholders agreement. Just for your benefit, a typical Series A shareholders agreement would be a 25, 30, 35-page document. And the Series J document that I was talking to you about, that was like a 110-page document, right? So it does take a lot of time to negotiate that document. And I'm told that iSafe would be a way to manage the timeline. Sahil, would you like to also contribute here? Sahil, did you mean to respond on this point, or should I?
No, no, sir. I just marked that. You'll be taking it.
I figured, yeah. Then there is a question from Shubham around, can warrants issue? Yes, warrants issue. Can it be a part of the investment strategy? It can be. So warrants is an instrument which is a stepping stone to equity shares, but you can certainly look at warrants. There may be structuring reasons why investors would like a warrant, which is not, which is where you don't get the full equity share. You only pay a part of the consideration and you only get a warrant, which is a right to get equity shares. Similarly, you could also do partly paid shares, but I just wanted to keep it concise. So that's why I didn't go into that detail, but you're right. Warrants can be a part of the structuring. To Ajit's question on which is preferable and whether to go with one for simplicity or combination, I think you will find that to some extent, this will be a strong preference of the investors. Like I said, earlier, that they managed their own risks, their own internal processes, etc. They would have standard documentation that they do. So to some extent, they will probably insist on one as opposed to the other instrument. I wish I could tell you that in real life, it is easy to have only one instrument and keep it simple. But the entire investment landscape, for tax reasons, for structuring reasons, for regulatory reasons, especially when you start getting FDI investors, is complicated. And so more often than not, we don't see only one instrument. We see a multiple set, sometimes all three of these, sometimes two of them, but it's very rare that you have a startup which has done multiple rounds of fundraise and which only has equity shares. Neela, I'm not sure the context in which the 26% requirement comes up. There is a Companies Act requirement that all super majority resolutions, all special resolutions should have 75% voting in favor. So if you have a 26% voting, you can block that. But other than that, I am not sure I've understood your question. Maybe we could take that offline. Naman, I think your question is the same as the previous question on what is preferable. So I'll skip that one. Anupam has a question, what's the advantage to investors over equity shares? And it's a win-win for founders in the same arrangements. Yeah. So what is the advantage to the investors? I think the key part of that is embedded in the conversion terms. So maybe if you don't mind, Anupam, let's finish the next slide, and you will see what I mean by conversion terms, and then maybe some of this would be addressed. But to your second question, let me assure you that honestly, it's not that from a founder's perspective, you are much better off having only equity shares or only debentures, preference shares. More often than not, you don't really care, because this is the ownership of the investor in your company. And so, you might as well let him get comfortable with which instrument he holds. I don't think that there is a very significant advantage or disadvantage of having a debenture or a preference share or an equity share. The obvious disadvantage or benefit, depending on how you look at it, of a debenture is that you can repay it, right? Because it's in the nature of debt. If you don't convert the debenture, you can repay the debenture. If that could potentially be an advantage or a disadvantage, because you could have a demand coming for repayment as well, like a loan. If you don't repay, there may be enforcement. Right? So that's one sort of thing to be mindful of. If it's a redeemable debenture. But other than that, between these instruments, to a large extent, it will be the investors who will sort of drive the conversation. To Uday's question on convertible note. Sorry, are all of these questions that I'm reading out, are they visible to all of the participants, Sahil?
I am not sure. So I think this may be only visible to the panelists. I'll have to check.
Can you just ask one of the participants to confirm?
I think Uday has raised his hand, so I'll allow him to talk.
Yes, so I want to confirm that I can see all of the questions.
You can see all the questions, right? Thank you. Yes. Because then I'm not repeating the question, I'm just addressing the question as we go along. So to answer your question, Uday, convertible note is okay. So when it comes to FDI instruments, then you should sort of be a little more mindful, because what works in the US or the UK context may not necessarily work because of regulatory restrictions. So a convertible note would typically have to be a compulsorily convertible debenture if it is a cross-border instrument. When it comes to NRIs, it is even more complicated, because NRIs could potentially invest as a resident, and they could potentially invest as a non-resident. It depends on the source of money. If they invest from their India money, then there is a NRO, non-resident ordinary tag, to that investment, and it is not considered FDI, and so you don't have to meet all the restrictions that come in FDI. If, however, they invest from overseas, then they will need to meet all the FDI requirements. One of the FDI requirement is that all instruments have to be compulsorily convertible into equity. I hope that sort of gives you some direction. If we open sort of the FDI conversation, that is sort of an hour in itself. So I'll just move to the to the next question. I must say that we're going a little slow, but at least the topics we're covering in its entirety. Joe, just move to the next question, please. So conversion terms, right? And this is the crux of why would an investor or you want a convertible instrument as opposed to a plain vanilla equity instrument. You may be at a stage of the life of the business where you may not necessarily have entire proof of concept, or your sort of revenues may not have stabilized right now. And if you try and get an investor in based on your current sort of performance and the multiples that you want, then the investor may end up holding a disproportionately high share of the capital, right? So to get around this, people use convertible notes. What are convertible instruments? Convertible instruments is basically where where what you're doing is that you're issuing X number of preference shares today with the condition that based on a future performance, the X number of preference shares will convert into Y number of equity shares, which will be a proportion of the total fully paid capital. What is the future performance? That entirely depends on your business and the commercial negotiations that you have with the investor. So for example, we've seen conversion based on future PAT, future revenue, future gross sales, future footfalls. It really depends on the kind of business that you are. But what in essence that does is, instead of valuing the business today on the basis of the performance of the business today, you get the ability to scale up your business and have the valuation multiple applied to the scaled up business, and on that basis provide equity shares to the investor. The obvious upside and downside there is that if your future performance exceeds your expectations and the investor's expectations in a positive way, right, where you sort of outperform, then the investor gets a smaller percentage of the company than he would in the ordinary course. But he's okay with that because he's getting a smaller percentage in a more successful company, so a more sort of highly valued company. Whereas if there is underperformance, because of the very nature of the instrument, you will end up having a higher proportion of the stake available to the investor in question. And that again is logical because the company's valuation is not as high as you all thought initially it would be. And so with the same amount of money, he ends up getting a higher proportion of the company. And so that more often than not is a significant driver of why you would choose a convertible instrument. And in the convertible instruments, more often than not, why you would choose a preference share as opposed to a convertible debenture. There are other sort of technical tax-related arguments as well, but that's the key here. And so you should be very careful when you negotiate these terms, because you should always keep one eye on the downside as well, right? Just in case the company's performance suffers. So for example, God forbid, people who raised money in December of 19 did not know that there was a COVID around the corner, right? And if they had agreed to future performance, the future performance could have dipped for nothing to do with them, and they would end up in a situation where the investor holds a larger proportion of the company. Then it would have been the case if the performance of the company were in the ordinary course. So that's how, in a very broad sense, how conversion works. There are some accounting aspects around that. There are some tax aspects around that you should definitely take sort of advice for. Because what I am doing is I'm just giving you the 30,000 feet view, but the devil is always in the details. But that's a broad sort of perspective of how convertible instruments work and why you would want them. One thing that you could potentially look at, and it is not necessarily market practice to agree to this in very early stage, but when you go to Series B, Series C, Series D, sometimes what you agree with investors is that instead of having a unhedged position, right, where if the performance of the company is very low, then the stake of the investors is disproportionately higher. You could range bound agree to a cap and a floor, right? What I mean by that is that even if the company's performance is exceedingly good, the investor will never hold less than X%. You commercially agree with them that that's how it would be. And on the flip side, if the performance of the company really suffers, even then the investor will never hold more than Y% of the company. So it's a range bound conversion mechanism. I must sort of caution you that for early stage investors, this is not the norm at all. This is more the norm when it comes to later stage growth equity or later stage investors. But again, just so that you know the technical concept, there is a concept of having a range within the conversion terms. More often than not, the conversion tends to be a time-bound thing. It again links back to the event, the trigger for the conversion, right? If it's a 3-year performance, then the conversion will happen in 3 years. If it's a 5-year performance, it will happen in 5 years. More often than not, in any case, the investors will insist that in certain bad case scenarios, right, like a bad faith action by the promoters, they should have the ability to convert into equity shares. I'll just pause for a minute here. If there is any question, I can take that.
So we have a question from Mr. Shashank Verma. I'll just allow him to talk.
Go ahead, Shashank.
Hello.
Yes, go ahead, Shashank.
Yes, sir. I need a clarity on a condition. Suppose a startup raises fund on a venture debt, and after some time, the venture want to convert a debt into a equity. Then, at what valuation means the company at that time of valuation will convert their debt, or at that point where the debt will raised?
Yeah. So I'll answer that question, Shashank, but just to sort of, from a conceptual perspective, we were not dealing with venture debt because we were only focusing on the equity side of investing. This is a question more that comes when you look at debt investments. But what my understanding is of how the venture debt works is that in the venture debt documentation, there is always a mechanism available for the venture to convert their debt into equity, either partially or entirely, depending on the facts and circumstances. More often than not, you will find that there will be a mechanism in the venture debt documentation of computing the inherent fair value of the shares for the debt to convert into equity shares. So they would have agreed in the detailed documentation as to what are the terms and conditions and what is the value at which conversion will take place. If you are in the process of talking to venture debt, or if any of you decide to sort of to explore that route, you are sort of well advised to keep an eye out for, if there is a conversion mechanism, then it should be clear in the document how the conversion will take place. Will it be based on then prevailing fair market value at the time of investing, par value? It could be anything. So you need to make sure that in the documentation it is covered. I don't know if Shashank, does that answer your question?
Yeah, yes, sir. I'm clear. Thank you.
Okay. Is there anything else, or should I move to the next topic?
So we can proceed further for now.
Okay. So there is a concept of participating and non-participating preference shares, but that gets rolled up into this concept called liquidation preference. So when we talk about liquidation preference, I will pick that up. I'm just taking a time check. It's Sahil. Do we have another 15-20 minutes, or? So
we have time till 1 o'clock, 1:10. We can extend it another 10-15 minutes.
Okay, thanks. So Joanna, will you move to the next one? Okay. So now the next topic I wanted to touch upon is that let's assume you have an investor, right? And you've sort of raised your first round, and now you need to get more capital into the company. And so what are the terms and conditions that are usually relevant when it comes to considering further rounds of investment in the company? So there are two concepts. Sometimes, excuse me, sometimes people tend to sort of mix up the two concepts, but there is one independent concept which is called preemption, and there is another independent concept which is called anti-dilution. What is preemption? Preemption is simply the right that an investor seeks that if he held a certain proportion in the company, just because you raise more money in the company, he should not get diluted. What I mean by that is, let's assume that in the first round, you raised 10% from a particular investor, and for which he had to invest X amount with you. Now, 1 year down the line, 1.5 years down the line, you're raising your next round of capital. Okay, and that is happening at a higher valuation because the company's grown, etc. If the investor wishes, he should have the ability to participate in that new round, so that after the new round also, he continues to hold 10% in the company. When there is a new round, obviously new shares are being issued to the new investor, which means that the total base of the capital increases. And if you do not have a preemption right, then what would happen is you were 10% on the earlier base. On the expanded base, you will become 9%, 8%, depending on how much new shares have been issued. So this is a right that investors typically seek, that in successive rounds, if they want, they should have the ability to continue to maintain their stake by investing more money into the company at that round's valuation, right? So it's not that they get it for free. They're not asking for this for free. What they're saying is that if I like the company, don't force me to get diluted. Allow me to bring in more capital so that I continue to be 10% in the company on an ongoing basis. That's a plain vanilla preemption. Sometimes, again, more in the late stage as opposed to in the early stage, you will find that investors actually ask for a preemption plus priority. What that means is that if you want to raise a new round, they will say that let us contribute to the entire new round. Okay. So if you needed X crores of money for your next round, that entire capital first you offer to the investor. If they do not want to participate, then you can go out in the market and get somebody else to invest. In any case, raising of capital more often than not is a matter that you need to agree together with the investors. It's not a decision that you can take on your own. But this is technically what is referred to as preemption. Anti-dilution is a slightly different concept. It again becomes applicable in fundraising only, but it's a different concept. So I'll just pause for a minute if anybody has any question. Okay, so
Those are no questions.
Yeah, no, that's fine. So the next concept is anti-dilution, and this is something that you should be a little careful about. I'm sure all of you have come across the term before. This is written about extensively by a lot of people who are active in the space. This is effectively a protection that investors seek because they are coming into your company without sort of proof of concept, or even if they're coming after proof of concept, they may still want a protection because if the company does not perform as well as they thought it would, and you're bringing in other investors at a lower valuation, then they want some protection. So what is anti-dilution? And anti-dilution is, and it is very case specific, right? Anti-dilution will apply on successive fundraisers as well compared to the previous anti-dilution. So this is stuff that you should be extremely careful about. If you've not read about this, I would strongly encourage. There are lots of very well written articles available online on how anti-dilution works and what are the pros and cons of it. What is anti-dilution is basically, suppose your first investor came into the company and he came into the company valuing the company at say 10 crores. Okay. And on the basis of that, he invested say 1 crore, he bought shares worth 1 crore from you. And so he's a 10% shareholder in the company. Now, the next round of money that you raise ideally should be a high round. It should be an up round. And so the valuation of the company should be either 10 crores or ideally higher than 10 crores, right? Because with time, the value of the company should have grown. But suppose the company is, for whatever reason, not doing as well, or the market has turned south and the valuation that the company is getting is not 10 crores, it is lower than 10 crores. And the company desperately needs the money. So you've agreed that even at a lower valuation, you will go and raise the money. What that does for the investor is effectively he came in earlier and took all the risk with you, and he gets penalized because the next investor coming in is coming in at a cheaper valuation, right? At a lower valuation. So no investor typically agrees to this and they insist on anti-dilution protection. What that means is, in the event that the second round happened at an 8 crore valuation, for example, then they will reset their original shareholding, assuming that in their original valuation, they gave a 8 crore valuation instead of a 10 crore valuation, right? So they get additional shares, assuming that in the example, they had made the original investment at 8 crore valuation and not at 10 crore valuation. Okay, and this is a fundamental protection that you will see in every term sheet. It'll be very surprising to have an early stage investor not insist on dilution protection, right? And so now, how do you do the math on dilution protection is actually quite complicated if you go into the technicalities, right? So there is what is called a full ratchet adjustment, and there is something called a weighted average ratchet adjustment. And I would again encourage you, the time that we have may not be enough for us to go into technicalities of math and calculation. But I would encourage all of you to try and read up on this online. This is an important aspect for you to know. So what I told you, anti-dilution is basically a 10 crore valuation gets reset to 8 crores, right? Now, the reason it becomes complicated is, suppose the first investor has invested 1 crore. The second investor could be investing either 5 lakhs or could be investing 5 crores, right? At that 8 crore valuation. And so how much is the protection that the investor gets can be computed either using what is called a full ratchet or using a weighted average ratchet. A full ratchet ignores the amount of money coming in the down round. It simply looks at the valuation of the down round and resets the first investor's per share valuation to that down round and gives you additional shares if you were the first investor. However, a weighted average ratchet keeps in mind higher valuation and the money that came in at the higher valuation, as well as lower valuation and the money that's coming in at the lower valuation, and applies weightage to it and accordingly computes the number. And so Joanna, just go to the next one. So just so that this is empirical to you, we have taken an example here of a company where the promoter 1 and the promoter 2 held 25,000 shares each. The first investor held 40,000 shares, and there was an ESOP pool for 10,000 shares. And that's how the share capital was. Now, the first investor had come in at a valuation such that the per share price was 100 rupees. And now the new investor is coming in at a valuation such that the per share price is 50 rupees. So it's literally half. It's halved in the valuation. And so Joanna, just go to the final sheet, please. So, like I said, we've done the math, but it takes too much time for us to go through the math here. So if you just see, this is a table which shows you, you should be looking at the last 3 columns. This is the table which shows you how the investors' shareholding changes based on if there is no anti-dilution protection, if there is full ratchet anti-dilution protection, and if there is weighted average anti-dilution protection, right? So 40% has become 33%. So he's actually fallen down because new shares got issued and he had no dilution protection, right? So even though it's a lower valuation, he gets no protection. In the second instance, his 33% has become 50%, right? It is actually increased because the valuation has gone down by such a high number that he gets disproportionately high benefit of it. And in the third calculation, the proportion has gone down, but it has not gone down as much as in the first round. And similarly, if you see the promoter shareholding, 25 becomes 20.83, 15.63, and 20.22. And this is a very, very vanilla, simple situation calculation of how anti-dilution works. But the point I'm trying to make to you is that as promoters, you could be in a situation where your shareholding goes from 25% to 15% or remains from 25% to 20%, depending on which type of dilution protection you negotiate and agree with the investors. I hope that was a little clear. I'll pause for a minute. In the meantime, Joanna, just go to the previous sheet, please. Joanna, one more back. So there's a question from Khyati around percentage. Honestly, depends, Khyati. It's not a one size fits all. We've seen as low as 1%, we've seen as high as 5%, 7%, 10%. It depends on how large the employee pool is, how many senior employee non-founder members there are, whether founders want to be a part of the ESOP pool or not. So it all sort of depends on all of those things put together. It's very difficult to put one number on it. Also, you need to be careful that whether or not ESOPs have a dilution impact. So that was actually the point. Joanna, can you just go to the previous slide, please? No, the one that we were at before all these examples. Yeah. So that's the 382 on the screen. The dilution impact of the ESOPs need to be kept in mind. What I mean by that is, if you have issued the shares to the investor and then you issue ESOPs, then the dilution impact of the new ESOP shares having been issued will be shared by you and by the investors, right? Because all pre-existing shareholders will get diluted for ESOP issuances. But more often than not, investors do not value the company without the ESOPs in it. So when they give a valuation to the company, they assume that the agreed number of ESOPs will be in place. And so more often than not, the dilution impact of the ESOPs will need to be borne by the promoters. And this is simply done by having the ESOP shares issued prior to the investor shares, and then the investors getting the agreed number of shares so that they get the percentage that they had in mind. There is another way in which the dilution conversation also plays up, which is not linked to the valuation, but I'm just pausing for a minute. There is nothing else that we need to address, right, Sahil?
Yes, sir.
Sahil, do you mind just clearing the questions that are still open?
Sure, I'll do that, sir.
Otherwise, it's a little confusing for me. Okay. So this is the MFN clause, and you will see this in a lot of documentation. What this means is that what investors could look for protection over is not that the next round should be at a higher valuation, but that proportionate to the valuation and the rights that they have in the company, you should not be giving more rights to somebody else at a relatively lower valuation, right? And that's where it gets a little subjective, But a lot of investors will put this clause in their agreement that if successive investors are given better rights, then those better rights will be made available to the earlier investor as well. So just to take an example, for example, a 10% shareholder comes in the first round and gets one director seat, and you decide that in the next round, the valuation is higher. So anti-dilution is not an issue, but it's a 12% investor and you're giving him 3 board seats, right? At that point, then the first investor will actually have a problem with that. And that's where this MFN clause comes in, that not only valuation, even the rights being offered to the investors should be commensurate and proportionate to the valuation that is being ascribed by the investor. This is a little bit of a subjective discussion as opposed to sort of a purely math sort of objective discussion, but you should expect to see something like this in term sheets. I'll now move to the different concept, which is around the role of promoters and the governance and how that works. Joanna, will you just quickly go to the... Oh, sorry, we didn't cover liqupref. Let's do that. So if you're not familiar with this concept of liquidation preference, I would again suggest that please read up on this. This is an important concept. What does liquidation preference mean? Liquidation preference simply means that then investor has the first dibs when it comes to any repayment from the company. Now, liquidation preference can be written in 2 ways. It can be written as a very narrow liquidation preference, which means that if the company gets wound up, right, in that limited situation where the company is getting wound up, in that situation, there is a preference to the investor to get their money back first before the promoters get any of the money that they have invested, right? That's a narrow liquidation preference. But these days, nobody writes the liquidation preference like that. What is written is a more sort of comprehensive liquidation preference, which is that if there is an exit that is being provided to the investors, or if the assets of the company are being sold. So instead of doing a company sale, you decide to do a business clump sale, right? Where you transfer your business to somebody else as a way to exit the business. For those situations, what is prescribed is that if X amount of consideration is received for the company as a whole, in that the investor gets a first preference to get X amount back. Now, what is that X amount? That is what is commercially negotiated in the liquidation preference. So you have a 1x liquidation preference, you have 1.5x liquidation preference. So it all depends on what is written commercially, what is agreed, but whatever that is. So let's assume in my original example of the 1 crore, 10 crore valuation company where 1 crore is invested by the investor. If that company tomorrow got sold for 2 crore rupees, then if it was a 1x liquidation preference, then out of the 2 crores, 1 crore will go to the investor in question, even though he holds only 10% in the company. And the balance 1 crore, depending on the terms, will either be shared by all the investors, or will be all the shareholders, or will be shared by the shareholders other than that investor, right? And so that is what is meant by liquidation preference. And liquidation preference can apply to a cash sale as well as a stock sale. So Joanna and I have worked for several years on this one company where we made an investment and the shareholders decided to exit, and they decided to exit by selling that company to a larger competitor in the same space, right? And the competitor did not give cash. The competitor issued its own shares by way of a swap to the shareholders of the company that we were representing, okay? And the number of shares that we got as a result of the swap was after figuring the inherent liquidation preference that different investors had. So we had this company where there were 5 investors who had come in at different points in time at different valuation and with different liquidation preference. So all of the liquidation preference was first factored in by giving additional shares not notionally giving additional shares to the existing investors and then using that notional number to do the swap, so that what came to each investor was after providing for its own liquidation preference. Okay, so this is an important thing that will come in. God forbid, if the company is not doing well, this becomes of great relevance. But even when the company is doing well, because this is linked to exit as opposed to a winding up, you should just be very careful of exactly what it is that you are agreeing to in the terms and conditions of the liquidation preference. Needless to say, the way liquidation preference works is in every successive round, you will have a new investor come in with a higher valuation. So his liquidation preference will be linked to his valuation. And then the previous investor's liquidation preference will be linked to their valuation. And in the waterfall, the last, the residuary benefit of the valuation will go to the promoters. So again, taking an example, and this is from about 5 odd years ago, we were representing this large media company which got sold to a behemoth in the space. And when they did sell, there were 27 rounds of successive investments and liquidation preferences that we had to build for, to figure out that of the X amount that was being received as consideration, which investor should get how much. Okay, and so this is extremely important and can get quite complex and complicated. And so I would again suggest and urge that all of you should familiarize yourself with how this works, and ask as many questions as you want to the investors as well, not with the intention of negotiating it, just with the intention of understanding what it is that you are agreeing to, because this will most definitely be a part of most term sheets. I'm pausing here for a minute. There are a couple of questions on the chat already, but they relate to ESOPs. If there are any questions relating to liquidation preference, maybe I could deal with that first, and then I could address the questions related to ESOPs. Okay, so Himanshu has a question around what is the condition ideally in regards to the ESOP being linked to anti-dilution clause. Himanshu, unfortunately, there is, like I said, no one size fits all. It depends on the overall sort of context of the conversation, the valuation that is being offered, etc. Because if it's a rich valuation, for example, then investors may insist that the promoters eat up the ESOP impact. If it is a tight valuation, then maybe the promoters will negotiate that it should not be only them, it should be pro rata. Sometimes ESOPs are not done upfront, sometimes ESOPs are done in time, in which case then more often than not, whoever is the shareholder at the relevant point in time eats up the impact of the dilution because of ESOP. I hope that answers your question. To Shivraj Singh, at the time of liquidity, what happens to the remaining ESOP? So ESOP again has become by itself a very complex structure. So broadly, ESOP can be a real issuance, or it can be what is called a tracking issuance or a ghost issuance or anything like that. If it's a ghost issuance, there are no shares actually ever issued, just the value difference is paid to the employees who are entitled to the benefit of the ESOP. But if there is actual ESOP, and that means the shares have been issued to a trust and the trust is holding those shares, then what tends to happen is the purchaser purchases the shares from the ESOP at the time of the liquidity event, and that money is used by the trust to then pay to the beneficiaries as per the terms and conditions of the ESOP plan that would have been reflected in the ESOP trust. Does that answer your question? Okay, great. Joanna, should we move to the next topic then? Yeah. So this is now, so all of the conversations we were having till now were around shares and valuation and how does that reflect. And I seem to have overshot the time that was allocated to me quite a bit. But quickly touching upon how governance works, investors will insist on either one or multiple investor nominee directors. they may sometimes ask for an observer in addition to a director, or instead of a director, and that's a right that they would want, because sometimes directors have fiduciary responsibilities and investors may not necessarily want to take the fiduciary responsibility of being a director, so they may ask for observers. There are detailed discussions that happen on quorum. So for example, promoters cannot hold a board meeting without the investor nominee being present, and if sort of successive meetings he is not present, then there's a detailed mechanism set out as to how you will carry on business in that situation. Usually you would find that travel costs, etc., at least in later stage, will start getting picked up by the company. Early stage, sometimes the investors are cognizant of not putting too much expense on the company, so they will not insist on the costs being picked up by the company. Once the company gets to a certain size and above, they will always ensure and they will always insist that the company has what is called a DNO insurance, or directors and officers insurance. These insurance policies are not the most expensive policies, but they provide insurance cover to directors and especially to nominee directors. And so this is a good to have in most companies, in most investments. And more often than not, you would find stipulations in the share purchase agreement, shareholders agreement, that the promoters will act as the promoters in every legislation, and the investor directors will not be held responsible for any of this. Joanna, go to the next one, please. Yeah. So let me just Vijay, if you don't mind, I'll take 5 minutes. Just these, I'll cover these concepts. I think the entire exit section we've not been able to cover, but that's okay. We'll just cover this, and if need be, we can have something else later. So what is it that the investors will definitely expect from the promoters as a part of the term sheet? So there is clearly an expectation that the promoters continue to be engaged in the business more often than not full-time, but if not immediately full-time, within a specified period of time full-time. And so there will be an employment agreement that the promoters will need to sign with the company. And again, this is all more often than not, right? This is not like 100% of the situations this will happen, but in a very large proportion of the case, we would expect that there would be something like this. So there will be an employment agreement. The compensation is also recorded in the employment agreement, which will have detailed mechanisms, including which will not allow the promoters to leave the company midway through the investment process, right? If the investor is investing so much money behind the promoters, then they would want to ensure that the promoters continue in the company. There is a concept in the employment agreements of termination for cause and not for cause. Again, as you grow more senior, more sort of later stage in the fund investment life, you will start seeing this. So the bigger funds will insist that the employment agreement set out what they consider termination for cause and what they consider termination not for cause. So for example, if God forbid your health is not keeping up, or there are other reasons why you need to sort of stop being associated with the company, then that is clearly a termination, but not for cause. However, if you decide to set up another venture, which they believe is a competitor of the venture in question, then that, for example, will become a termination for cause. Typically, termination for cause will have severe penalties, either in terms of rupee penalties or the ability to take away your shares for lower than fair value, etc. So you should keep an eye out for the linkage in the shareholders agreement between your forced exit and sort of any termination for cause. They are also sometimes referred to as bad boy acts that you may commit in the course of your engagement with the company. Another thing that always comes up is that there may be intellectual property that may already have been developed, or that may develop as a part of the business, and there will be a clear expectation that all intellectual property should be owned by the company in which the investor makes the investment. They will always insist that there cannot be a situation that the intellectual property is held by somebody else, for example, the promoters in their individual capacity, and the investment happens in that in a different company, unless you've specifically negotiated that it will be a license as opposed to an assignment of intellectual property. Other than that one situation, they will insist that all of the intellectual property related for the business, required for the business to run, should be owned by the business and the company in which the investment is being made. They will also stipulate limitations on what you can do outside of work. So for example, they will insist that all of your professional time spent should be with the company. You should not do any other business outside of this work, because they may not necessarily worry as much about what that other work may be, but they want you focused. They want you sort of concentrating on creating value together in this company. And so you will see some of these restrictions come through in the employment agreement. On top of this, under the shareholders agreement, there will be a detailed non-compete and a non-solicit mechanism. A non-compete is basically an obligation that the promoters undertake to not carry on any business which competes with the business that the company is carrying on or could potentially be carrying on. And the non-compete is for the duration of the presence of the promoters in the company and for a specified period of time after. Because the last thing an investor wants is that the promoters exit from the business and the next day set up a competing business, right? Because they are the ones who know the business the best. So they will always insist on some basic level of non-compete extending to beyond the term of the shareholding. There are legal restrictions on what you can and cannot agree in terms of non-compete. So thumb rule, if the restrictions that are being imposed on you are reasonable, then they will be upheld. But if they are disproportionate, so for example, the company only does business in one state in India, and the investor says that you cannot do this competing business in some random state in the US, where there was no connection of the business earlier, there is a good chance that that may not be upheld. But again, that is if it goes to court and if you decide to take it to court, right? So there are those kind of technical aspects that come around non-compete, which you should take professional advice on. One thing that we are increasingly seeing now is that investors insist that promoters not make other investments. And this is especially for those promoters who are serial entrepreneurs, right? May not necessarily be relevant for a first generation entrepreneur. But for example, if you have made several investments in the past, investors will ensure that you don't make angel investments, that you don't make private investments, because they are worried that tomorrow you may see the return from that private investment being more than the core business into which the investor has invested. And so you will shift your attention and focus from your company to the other company. So these are all sort of things that you should expect to see. You should also expect to see a consolidation of all growth and revenue prospects of the company within the company, right? So if earlier you were sort of operating as 3-4 companies, one doing some business, one doing some other business, maybe sort of stay below a certain threshold of revenue, whatever it is, they will insist that all of those businesses be consolidated into one vehicle and that they invest in that one vehicle. For a variety of reasons, but more than anything else, if they're investing in a business, they want to invest in a company which has all of the businesses within it. Sometimes this requires a lot of restructuring. And so again, you should consult with tax advisors as to what the impact of such restructuring will be. I'll just take, if there are any questions.
We have a question from Karthik.
Yeah, Karthik, go ahead.
Hello, sir, again. I hope you can hear me now.
Yes, please go ahead.
Okay, the question about you're limited to shares to private equities or let's say private limited companies or LLPs. We have a document while time of registration of the company. If I am presumably right, we have a memorandum as AOA. How does the AOA is connected to the conversation of the details that you have provided? Is there anything linked to it, or is like something that is different to the policy of the company, or like what policies that we discuss with the investors?
So AOA is more the governing charter for the company, MOA and AOA. But the conversations that we are having will be reflected in a detailed document, which is typically called the shareholders agreement or the investment agreement.
But the
And-
same clauses are there with the AOA, like, shares and, the
I-
equity and all those stuff. All are mentioned when the AA at the time when you register the company. But that is the governing body, as you said. But the
Yes.
similar clause to what we talk to the investors also are the same policies that we have to follow while we have been registered, or is this a safeguarding for us later on when we actually say that this investor is tied up right now, we're leaving them, we're going for some other person. So somewhere like that, do we have some discussions on it?
So the simple answer is, till you have a shareholders agreement signed, you need to comply with the AOA only. Okay. Once you sign the shareholders agreement, as a part of the document, anyway, what investors do is they modify your articles of association to bring it in line with the AOA. With the shareholders agreement. Right. So if there were certain provisions in the articles of agreement, but the shareholders agreement have different provisions on the same aspects, then you will modify the articles of association to incorporate the changes from the shareholders agreement. So once you have a shareholders agreement, then you need to comply with both the AOA and the shareholders agreement. But till you have a shareholders agreement, which means that till you have not received your first investment, then all you need to do is comply with the articles of association.
Okay, but the same continuation to the same question: how frequently we can change the AOA, the articles of association?
It's a simple act. The Companies Act
as per
provides
the yearly, or is it like every time as an in annual general meeting? Is it like annually, or is it like bi-quarterly?
No, Karthik, you can do it as many times as you want to. There is a detailed process set out in the Companies Act on how to amend articles, but it's not something that you need to do annually, biannually. Whenever you want to do it, you can change your articles of association. You just have to follow that process.
But it's the same governance process when we discuss with the investors. The primarily.
Depends on why you're changing the article. So for example, if you're raising capital, more often than not, you need to change your MOA for that as well, irrespective of whether an investor comes in or not. So it depends on what you want to do and whether or not that is permitted by the MOA and AOA. But if they are not permitted, then you will need to amend it. Typically, it takes 15-30 days to do it. So it's not a very difficult process.
Thank you.
Sure. Any other questions around any of the topics around governance?
No, sir.
Okay, so I think what has happened, unfortunately, is that we've already sort of overshot the time provided to us. So unless Vijay, you or Sahil, you have a different perspective, maybe we could just bring this to an end right now. The other sort of part of this was around exits, but I just think that we may not be able to cover that. What do you suggest?
So I think fine, good. It was a good interaction altogether, and a lot of queries were addressed for the startups founders. So what we can do is, in case startup founders have any specific queries, they can write to us. We'll connect them to you offline and help them out. That's
So just one word of disclaimer from my end. I have a day job outside of this. So while I'm happy to sort of engage and provide questions, there may be a little bit of delay at our end. Joanna and I will try and get back to you as soon as we can, but there may be delays. So just please factor that in.
no more questions. I think time to wind up the session. Thank you, Jay, for a very informative session. In fact, our CEO, Ojasvi Bubur, was there for the entire session. He wanted to be talking to you, but due to some erratic situation where the connectivity was completely low, he could not take it, but he would like to talk to you offline, and we'll keep on doing such sessions. We'll also explore some more sessions with you down the line where
Sure.
Our startups can get maximum benefit out of it. Thank you so much,
Happy to do that.
Joanna. Thank you, Jay. It was wonderful having you all for this perfect session.
And just one quick word from my end. I just come and do all the talking. It's people like Joanna who spent the hard time and effort to put this together. So as much as I'm doing the talking, it's actually her who's put everything together.
Thank you. Thank you.
Thank you very much, everybody.
Thank you,
Thank
participants,
you, sir.
for
Thank you, Joanna.
being a part of this session. It was great having you all here. We look forward for getting your queries. Please share us to the email ID provided to you. Thank you so much. Stay safe